Good morning, everyone, and welcome back. Delighted to see so many of you here, and again, some new faces in the audience. I think this session for us, is picking up on some of the themes that we've heard both from Jerry, but also from Toby's session, particularly around the positive growth in our sector. And I think we've seen the pendulum swinging away from ownership to usership. And I think that's very positive. We've seen that's demonstrating positive confidence from consumers and individuals and small businesses. But also there's, I think, a big boost for leasing as being an attractive option to people's motoring needs. So for us, that's all very good news. But, you know, when you start to look at the level of personal debt reaching record levels again, pre-credit crunch, for those that in the audience that have gone through that process, recalls that the level of debt was probably at the same level we are now in. And again, when you start to think about that in the context that this has not gone away from either regulatory or the media gaze, everyone's looking at this sector as one of the fastest growing areas of debt. And when you get a regulator, as you've heard, starting to carry out a review, you know, we've got a very different regulator. This regulator not only has teeth, but as we've seen since it's taken over regulation of consumer credit, it's prepared to use those teeth. So it's very capable and willing to act. And I think that's the reason why there's been a lot of perked up interest in our sector. And when you see the regulators starting to look at our sector, you take that regulator seriously. You know, it can disrupt what we do and how we do it. And we've not just got the conduct regulator, the financial conduct regulator looking at us, we've actually got the Bank of England's Prudential Regulatory Authority looking at us as well. So there's two interesting dynamics. And when you start to have two sets of regulators looking at our sector, you know, I think we've got to take that seriously. And when you start to think about what are they looking at, you know, how are the products sold? Are there any consumer harm being caused by what we're doing? And actually looking at, is the market actually functioning well? Is it doing, serving both consumers with choice, and is there sufficient competition? And when you start to see the regulator, we've got over now just over 50,000 firms that the FCA authorises. 1 in 5 of those firms is in the motor finance sector. So you can see why there's been a lot of interest by the regulator into our sector. And, you know, we're really pleased that, you know, to help us through some of the strategic and I think operational challenges, got a very eminent panel to take us through that. And I think, you know, what we'll see through both Lauren from Black Horse's point of view, what are the lenders thinking about? We've got Louise from Experian. And I think Louise is coming to us at a time when we know the regulators are trawling through all the credit reference agencies. Not only are they looking at, you'll hear a little bit more, not only are they looking at what's the type of consumer that's looking at motor finance, but what's the default rates, what's their personal level of debt, who are the vulnerable consumers, and who's actually selling products to that. So that'd be quite interesting. And again, delighted to see Nathan again. Nathan also helps the BVRLA with its inspection program, but Nathan brings wealth of experience on the world of compliance. I'm really delighted to have I think a very heavyweight panelists together. If I could hand over to Lauren. So what we'll hear is the session will run, we'll have each of the panelists giving about 6 to 10 minutes of their views on what they see and perhaps what we should take on board. And then after that, we'll have a Q&A session. And because of time, I'm happy to field those questions, but if you have any pressing questions that you want us to ask, do feel free to put your hand up and I'll make sure we get through that. So if I could welcome Lauren to the lectern.
Thanks, and I'll try and stick to the 6 minutes. So over the next few minutes, I'm going to talk to you about why we're seeing growing interest from the UK financial regulators in the automotive finance industry, and explain why at Black Horse we don't think this is something the industry should be too concerned about. So as Jerry alluded to earlier, barely a week's gone by this year when the automotive industry hasn't been in the headlines. And it's not all been about self-driving cars and diesel emissions. Motor finance, and particularly the rise of PCP, has also been in the news, with headlines such as these causing confusion for consumers and for dealers, probably not being particularly helpful, especially as Jerry pointed out with the errors in them around the differences between PCH and PCP. So why the sudden interest? Well, the flow of new cars into the UK market over the last few years has been matched by a rise in motor finance across both new and used vehicles. Lending outstandings and motor finance penetration are at an all-time high, and it's the growing scale of the market that's brought it onto the radar of regulators. More than 5 million people now in the UK now have some form of motor finance agreement or have had one in the last 5 months. And with around kind of £60 billion worth of outstanding balances, we think that the scale of the market means that actually the scrutiny we're getting from the regulators at the moment is no more than a market of this size deserves. And this growth has been against a backdrop of benign economic conditions. So UK interest rates have been at an all-time low until earlier this month. And this, coupled with a push of stock from Europe into the UK and the availability of finance deals under PCP and PCH, has led to that rise in motor finance. But consumer debt-to-income ratio is growing, and it's growing fastest in motor finance, as you can see there, as people move away from unsecured personal loans. And I think that's evidenced by the fact that the majority of adverts for new cars these days are headlined by the monthly price rather than the on-the-road price of old. And obviously now monthly car payments are typically the second largest outlay for a consumer after mortgage or rent payments. And with rising levels of indebtedness, the concern from the regulators is that if the economic conditions worsen or interest rates continue to rise further, will consumers' disposable income be challenged, and will they be able to continue to afford that debt? And will we see rising levels of default and the impact that then that flood of used cars back into the market could have on used car values? And the two regulators are looking at the market through different lenses. So the PRA are particularly concerned with the residual value risk that's now sitting on the balance sheet of lenders. And it's worth pointing out that the PRA only actually regulate the UK banks, whereas the bulk of their outstanding balances are sitting on the balance sheets of manufacturer captives, which aren't subject to the same rigorous stress testing procedures that the banks are. So there is a risk that some lenders are particularly exposed to that downturn in the market. And the PRA actually say that responsible motor finance lenders should be setting GFVs in a prudent manner compared with the expected future value of the car to help mitigate exposure to those losses in the event of a downturn in the market. They also say that lenders should be assessing the ability of their motor finance book to withstand a significant downturn in used car prices, and they'll be asking the lenders to model the impact of a shock in the used car market in, say, 10% increments, beyond levels that we've historically seen in terms of a downturn. And the FCA's concern then is whether the market and the sales processes work for consumers and result in fair outcomes for them. Their particular focus is on the structure of the market, and I think it's just worth pointing out at the moment that there's no formal investigation at the moment from the FCA into the motor finance industry. What they've been doing over the last year is fact-finding with a view to conducting some further work in 2018. And they've been engaging with the lenders and with other players in the market just to really build their understanding before they start to dive deeper into the practices. And in fact, Andrew Bailey, the chief exec of the FCA, recently said they don't see PCP and PCH as bad per se. They understand that people see a car as an asset and that they're happy renting it rather than owning it. But what they want to ensure that consumers understand the products that they're signing up to and the sort of features and benefits. Because I think motor finance and leasing can be a complex place. For those of us in the industry, there's plenty of acronyms, and I've just moved from the leasing world over into Black Horse, and I'm amazed at the number of additional acronyms that exist in a regulated world. And the FCA want to be reassured that customers understand the choices that they're being offered at point of sale. Do they understand the deal that they've ended up with and how much it's going to cost them? Do they understand the features and benefits of the various products? And have they chosen a product that actually suits their needs? Because I think it is worth bearing in mind that actually, PCP and PCH are great products for people who want access to a new car at an affordable monthly price. And the FCA recognise that, but just want to make sure that the practices are fair and consumers are ending up with a deal that they actually thought they wanted. So where might we see the FCA continue to focus over the next year? Low-quality motor finance lending has grown the fastest in the last couple of years, but it still remains a very small percentage of the market. Nonetheless, the FCA are concerned about vulnerability of customers and affordability, especially with the economy looking to turn and interest rates on the rise. So that will be an area they continue to focus in. They also want to understand whether customers realise their options at the end of the contract. So in a market where used car values might decline, do customers actually have the options they thought they had when they first signed up to the contract? Can they buy the vehicle because they'll be left with a negative equity? Are they happy just to walk away and be left without a car? Or are there options to trade in, and will that trade-in option actually give them the financial return that they need to pay off the outstanding balance? And I think increased complexity obviously continues to reduce customer understanding. So the more products that a dealer or a broker is having to sell, the more products then they have to explain to that customer to make sure they understand their choices. And with that increased complexity, with each choice added, that complexity increases. I think that increase isn't linear. And finally, I think the PCH market's unlikely to remain immune to FCA focus. The standards and regulation, including affordability assessments, are currently less stringent in PCH than they are in PCP. And I think we'd rightly expect the regulators to focus more in this area going forward, because why should the standards for assessing affordability on a PCH be any different to a PCP? We need better mandated affordability assessments across the market, because it shouldn't be an area of competitive differentiation, but a core part of our industry lending responsibly. So just to summarise, we'd expect to see continued focus from the regulators on the motor finance industry. And I think given its size and overall importance to the UK finance sector, their interest isn't surprising. And actually, we welcome the additional scrutiny to ensure that the market continues to operate sustainably and with fair outcomes to consumers. Thank you very much.
Good morning, everybody. I'm going to pick up where Lauren left off, and I'm going to talk in a little bit more detail about affordability assessment and residual value risk. So the two major issues that the regulatory authorities are focusing on, and put some more meat on the bones as to what that will mean for you guys in the room. The slide I'm showing at the moment has come from our economics team. So within Experian, obviously, everybody is pretty much aware of the fact that we are one of the largest credit bureaus in the UK. We are sat on a huge amount of data about consumers in the UK, their financial position. We can use that data very effectively. We can also combine with that the expertise we have available through our economics team to get a view of how different types of consumers are likely to be affected going forward as the economy changes. Now, there hasn't been too much mention this morning so far of the word Brexit, so I'm going to mention it briefly. So we don't really know what the impact of Brexit is going to be, but my economics colleagues have put together a view on what they think it's going to mean, and then we've overlaid that onto different sectors of the UK consumer population. So we broadly split the population up into groups, lifestyle groups. So on one hand, we've got the bright futures. They are people who are bright, relatively young, got a good career ahead of them. So relatively at the start of their career on relatively high incomes with capacity to earn more in the future. Down at the other end of the scale, we've got a group called traditional thrift. They tend to be older people, still employed, but in relatively lower income jobs, more manufacturing, more traditional sort of sectors. The two groups that I've put a circle around there are young essentials, so people in their sort of early 20s, still earning relatively low amounts of money, typically with young families to support, mostly living in rented accommodation and in some way dependent on benefits for their overall income. Stretch finances are the sort of similar group, but moving up the age scale a little bit more, so they're middle-aged. They still have dependent families, but more sort of teenage children. But again, might have some instance of home ownership, but also a high proportion will rent their homes. But again, in sort of lower income jobs. Those are the two groups that going forward are going to be most impacted as the economy takes a downturn and household incomes stall. So we're not talking about unemployment rates going up, we're talking about incomes getting squeezed, because incomes are going to remain static in those sort of sectors that those types of people are employed in, but cost of living will rise. So we all know utility bills are going up, all that sort of thing. So that just gives a bit of insight. We're not expecting the economic outlook to be gloomy for everybody, but there are particular sectors of the market that are going to be impacted, and that will mean for certain lenders in the room, particularly focused in those types of customer bases, you are more likely to be, your customers are more likely to be impacted. Now, the FCA have access to the Bureau data. They are monitoring and analysing what is going on in the UK credit market. They are using that, as Lauren's already pointed out, to drive a lot of the areas that they're focusing on and they're looking at. So they've seen already the significant growth in lending in motor finance. They're seeing that a lot of the demand for new motor finance lending is coming from those two sectors that I've called out, those two segments of the population. And they're also beginning to see very early signs that arrears levels or delinquency on motor finance lending is rising. Put all of those together, and that is why they're interested in making sure that when lenders are financing PCP and other forms of vehicle finance, they are making a thorough assessment of individuals' ability to repay that debt. Okay? So what does all of that mean for your organisations? It really means two things. It means you've got to look at your customers from the perspective of assessing their affordability. Initially, people think that's at the point when the person is wanting to purchase the vehicle. That's true, that affordability assessment is very important there. But actually what I want to call out today is it's important throughout the customer life cycle. So we all know that the market is getting very competitive. So retaining the customers that you've got, increasing the loyalty of your customer base so that you can offer them further borrowing, you can offer them a new vehicle as their old deal is coming to an end. So if you want to do that, you need to be informed about what their affordability position is at that point in time so that you can go out and offer them potentially an upgrade to their vehicle, which will mean an additional monthly cost. You've got to be sure that they can borrow that extra amount of money. So this is why I'm saying affordability assessment isn't just at the point of writing the deal, it's the point of going back and remarketing to that customer as well. So this means for organisations that you need to be regularly reassessing people's affordability positions because it changes. Yeah. Unfortunately, some people are going to struggle to make their repayments no matter how good they looked when you wrote the deal. So when hopefully a small number of them do go into collections, again, affordability assessment comes into play there. When you are talking to customers about rescheduling their repayments, you need to make sure that any new repayment schedule you agree is something they can afford. So again, affordability assessment comes in there. From a vehicle perspective, Lauren's already touched on the fact that the PRA are very interested in residual vehicles. Now, again, as Lauren said, the PRA are focused on the banks and the lenders that they regulate. That doesn't cover by any means the vast majority of the market. But this issue is still relevant for any organisation that has money tied up in vehicles in that financial asset. So at the beginning of the journey, when you're looking to make that vehicle available to a consumer or a business, obviously you will look at what is the value of that vehicle going to be at the end of the deal. You'll have a view on what equity you would expect to have at the position when that deal comes to an end, or in the rental case, you want to take the car off rental and actually dispose of it. But that future value of the vehicle will change over time as the economy changes. So the PRA are very well aware of the fact that we're expecting a downturn, and they're expecting two things to happen. They're expecting the supply of used vehicles on the market to go up, driven by the fact that over the last 3 or 4 years, PCP has happened, the significant growth in PCP has happened, and so that means there's suddenly a lot more used vehicles coming onto the market. Second thing, for the reason that I've already mentioned, we're expecting consumers' disposable incomes to feel the crunch, so people are not going to be able to go out and buy new vehicles to the same extent as they were previously. So that gives us a sort of oversupply and an under-demand problem, which tends to suppress market values. So actually what the regulator is expecting you to do is again on a regular basis to be updating your view of what the future value of the vehicle is going to be, and to be building that into your forecasts of loss. So very much in the way that mortgage providers have to do regular stress testing of their mortgage portfolios, banks have to do it for credit cards and all of those other products. They're now expecting organisations that are funding vehicles to do exactly the same thing. So let's talk a little bit more about affordability. Again, the regulator did an exercise a couple of years ago when they did a review across the whole of the lending market. So it wasn't primarily focused on motor finance, they looked at everything. And one of the big areas they called out was that in some areas of the motor finance market, that affordability assessment wasn't as robust as they would have expected it to be. And they have recently issued a consultation paper that talks to what they do expect. And in a very simple way, I've sort of tried to picture here what they do expect organisations to do. So the first thing that they expect organisations to do is to capture some data that helps lenders understand the customer's likely affordability position. So at a very high level, you've got to ask them how much they earn, and you've got to ask them a little bit about their family circumstances. So things like, do you own your house or do you rent it? How many dependent children have you got? The reason you need to know that sort of information is that will typically inform how much an individual's likely outgoings are. You know, if they've got 3 kids, they've got school uniforms and all that sort of thing to pay for. If they haven't got any, it's a lot cheaper, that sort of idea. When you ask them for their income, you've got to verify that they seem to be telling you the truth, because it is relatively easy, unless you verify that information, for individuals to maybe manipulate it. So you've got to have a process for checking they've told you the truth. Then you need to have a quick look at their existing financial commitments. How much debt have they already got? If they're already highly indebted, and it's obvious they've got no capacity to take on any further borrowing, you can obviously decline at that point. Most people presumably would pass that test. And then you move into the last stage of the process, where you've got to look in detail and understand exactly how much they have left every month to support the new borrowing. So you've got to get a view of how much they're likely to be expending each month, and there's very prescriptive types of information you have to take into account. I think a lot of people in the market think that's an incredibly onerous process. Haven't got time to cover it all now, but what I can say is there are a lot of technology solutions coming to the market now that streamline a lot of that process, remove a lot of the friction from the customer journey. In some cases, you should be able to do almost instant decisioning. And I'll just touch briefly on the fact that open banking comes into play at the middle of January, 13th of January. That will make available information about individuals' bank statements, so all the full detail of what they're spending their money on, providing, of course, they give consent to that, will become available in an electronic form. And that is an amazing tool that will help organisations streamline affordability assessment. So what does all of this really mean for organisations? It means you've got to get ready for some new challenges, and people may be at varying stages on this journey. But certainly from a people within the organisation point of view, you need to build up some capabilities around affordability assessment and understanding the technology that's out there to streamline the journey and help you design the most effective process you can. You need some project management expertise, I would have thought, because this is going to be quite a significant change program in a lot of organisations, and it's going to touch potentially dealers, brokers, and so you want to manage that process well and roll that new process out effectively. From a data perspective, you've got to be prepared to get some more data to inform that affordability decision. And I've mentioned some of the data sources on there. And then last but not least, those organisations that are prepared to invest in technology and use that to innovate will actually succeed, I believe, in this area, because they will be able to effectively undertake this process without really impacting the customer journey, without switching off dealers from wanting to deal with you. But it is, for some, it will be a significant change, and it needs to be thought through very carefully. So I hope you found what I've had to say insightful and not too scary and not too onerous. And I'll hand over the baton.
Good morning. I'm just going to spend a few moments just talking you through some of the success stories of some of the companies we've been working with this year, and talking through what they've been doing and how they can evidence to the regulator that they're treating the customer fairly and therefore building their business. We've seen that companies who take time to invest in the compliance side of their business have competent, confident staff who treat their customers well. They can reduce complaints, but most importantly, is what you guys want to hear, is they can also drive sales. We don't perceive that compliance being a brake on your business. It's actually what will underpin sustainable growth through your business. We'll just take a few moments just to look back. Many people in the room entered regulation through the FCA back in 2014, and the reality was at the time the thought process was, let's just get through, let's just get authorised, let's put the basics in place. As time's moved on, the FCA didn't really pay that much attention, as we've heard, over the first couple of years, but it significantly changed in the last 12 months. I won't repeat what's already been said, but clearly there's a dramatic shift in attention on the sector. The one extra that I would pick out is the average fine for an approved person was announced earlier this year. I don't know if there's any approved persons in the room. The average fine was £165,000. Now, admittedly, that's skewed slightly by one or two heavy fines, but it should underline the importance of people who have the title of an approved person, the responsibilities that they have, and the things that are being carried out on their behalf within the business. The things that are already under investigation at the moment will carry through into 2018. The approved persons regime will move to SMR, there's GDPR, and a host of other things will come to fruition. So the question for all types of businesses is, if you did maybe the bare minimum 2014, what steps have you been taking over the last few years to get to the level the FCA now expect of you, and to keep up with the ever-increasing pace change? So the question is, what are you doing to keep up? And hopefully I'll just talk through some of that over the next few moments. I put 8 blocks there. We see what successful businesses are doing is putting together these 8 blocks, but it's only as strong as the weakest link. You obviously start with a strong foundation. In every business, that's going to be your policies and procedures. We still visit a whole variety of different businesses in the sector where their procedures and their policies are completely detached from what their people are doing on a day-to-day basis. They're trying to recall policies that they haven't seen or heard of, rather than just telling what they do on a day-to-day basis. And we try and encourage companies all the way through to try and have relevant policies that meet the customer's needs, that staff are confident and happy delivering. So we encourage all companies just to look at, how detached are your policies and procedures, make them more concise, make them more in favour of the client, but that will increase sales. We've seen it happen this year with a number of companies. You're looking at sales processes. We've already heard of the changes in relation to affordability, but there's wider work around sales processing he's doing, financial promotions and complaints. I'm just going to spend a few minutes talking specifically about complaints procedures because there's an awful lot going on. I don't know if anyone would recognise this face in the room. He sent you a lovely letter. I don't know if anyone in the room actually received the paper version, but he sent you all a letter by posting it on the FCA website. His name is Jonathan Davidson, Director of Supervision. He sent a 4-page letter to everybody here. The challenge is around how firms within consumer credit, and obviously there by default motor finance, are dealing with complaints. The tone initially was quite positive. He spotted good examples of some of the things that are happening in the sector, but they don't write a 4-page letter for no reason. They found material non-compliance and under concerning practices in relation to complaints. They were re-establishing the link between Complaints being a strong indicator of the culture of a business. And just reiterating that some firms, unfortunately, consider complaints as a nuisance that will lead to a culture of non-positive customer outcomes. There's 5 key findings. I won't go through them all today, but the encouragement, if you have not acted on this letter, you need to have it high in the agenda before Christmas. There's 3 key actions. Every firm must review their existing complaints procedures and how well staff deliver it and their confidence in doing so. You must identify where there are gaps and rectify them. And 3 is a very important one, actually. Evidence in detail, exactly who did it, the dates involved, and what the actions were. The FCA have been very clever. They've done it in other markets before. They are effectively drawing a line and saying from this day forward, you're expected to be working to the standard we expect. And they attach some warnings. They have the right to request this information at any time in the future for any reason, and you'll be expected to present it. And they reconfirm that they have the power to send you to enforcement. The point of this is compliance procedures need to be appropriate, they need to be relevant, and they need to be addressed if you haven't done so imminently. In fact, there's a more slightly positive area. Companies that do have effective compliance procedures can put training in place to build the confidence of staff, improve sales, improve the whole environment. We also spend time with people talking around approved persons. And again, if people are inexperienced in this area need to understand their responsibilities, training of approved persons is a really key area, particularly with everything that's going to be going on over the next 12 months. So consider if there are any gaps and what you can do to help. And you've obviously got the BVRLA new training modules as well, which will be helping to build competency and confidence across the sector. Where there are gaps, don't be afraid to bring in expertise. We've talked around maybe needing that on affordability now, but there's lots of other areas about trying to get it right first time. We see lots of companies with the attitude of trying to get it right, but maybe it takes 4 or 5 attempts to get it right. If you get right people in at the right time, you can get things done quickly and you don't expose yourself to risk. So consider, some firms can afford full-time staff, extra staff, but others may just need some interim support. It's also important they have sufficient profile in the company to be able to raise issues with senior people in the business, i.e. get things done that affect customers. Probably the single area that we're affected by most is compliance monitoring, risk-based active schemes allowing people to assess maybe the salespeople in their organisations, whether they're high risk or low risk, and the level of scrutiny they place on them people. We've also seen from the flip side, though, where you explain to your salespeople why this is being done, that they empowers them and that they understand where the standards are. And it's similarly with regard to due diligence of third parties for different types of organisations. Do you understand what's happening under your watch, under your responsibility? That then builds to the MI that you produce. Goes into compliance MI suite where you understand your business. I'm sure you've got your business risks for lots of different commercial parts, but does that also run to your compliance MI to allow effective oversight by the management of the company? I've put up there just a few, and it does vary between the different types of business you've got. Business volumes, complaint types, product bias, funder bias, funder declines, cancellation rates. Those KPIs, key performance indicators, should be relevant to your business, but allow you to understand where you need to focus. And crucially, it also helps you with the culture of the business, because this is going to underpin your staff incentives and your performance management. Again, I'll just fly over this, but the FCA in July released information that 40% of the schemes they reviewed had a high or very high risk of customer detriment. They always go for every sector, look at incentives, because it drives the culture that sits within your business. Again, I've seen companies who've instigated new incentive schemes this year that have driven much higher sales, but also have done it in a way where they're putting the onus on people to understand their responsibilities to get it right. The FCA have also produced a list of factors of some things that create more risk in the business and reduce the risks. Now, this is not to say the ones that increase the risk are bad and must be removed from all businesses, but there should be counterweights and balances, checks and measures to make sure that the culture is right within your business. You want good sales, not sales that are going to go bad. So high risk areas, or too many high risk areas, obviously are linked to too much sales related, purely volume driven or profit driven. Particular promotions, competitions, 100% commission. You know, without the counterweights, these can cause problems. Factors that reduce risk, I talked about fixed payments, and a lot of companies have moved towards these, but also building in mechanisms where if your staff are not behaving as you'd expect of them, they would expect to be disciplined or have a removal of bonus or receive bonus clawed back. And, you know, disciplinary measures for quality and quantitative things as opposed to just sales. Bringing it towards a close, the FCA expect all organisations to have some form of independent assurance on what they do. Firms who just exist in their own entity struggle sometimes with just being able to get the challenge they need to drive their businesses better, and 12 months can pass doing things in a slightly the wrong way. So always encourage independent assurance to just make sure you're on track. And we also encourage open relationships with both the regulator and the associations such as the BVRLA, timely reporting of information on top of things. And if you do need to raise an issue, please raise it sooner rather than later. It's better you identify it and trigger it rather than the other way around. So in closing, these are the 8 pillars that allow you to protect your customer, to protect your business, but also to grow your business in a really confident way for the future. This is what evidencing treating customers fairly is about. And the question is, are you keeping pace? What are you doing? Thank you.
Thank you, Nathan.